Our market master of the day is with us. Harsha Upadhyaya is Chief Investment Officer, Equity at Kotak Mutual Fund. Harsha, great to have you with us here. Thank you very much for your time. Can we start to imagine a time when we will stop calling this a counter trend move or a bear market move, and just call this a trending higher market and not a counter trending market? What's your sense, Harsha? Where are we at?
Good morning, Krishna. I think it's a bit too early to say that we are in a different trend altogether. But clearly, the market mood has changed over the last month. We have seen that the narrative, which was solely focusing on interest rate hikes and inflation pressure, etc., has moved towards looking at what would happen 3 months down the line or 6 months down the line. And the expectation is, as you roll forward, inflation is not going to be such a big issue to contend with. So to that extent, there has been some buying that we have witnessed at the lower levels. And clearly, the foreign buying has started, which was not there between October 2021 to June 2022. We have seen finally in the month of July, they turning into buyers, although it's been a very small number as of now. But at the same time, we have also seen steady flows into domestic institutions. So all of this has led to some bit of a stabilization in the markets, I would say.
Okay, well, just taking a bit of a detour, Bajaj Auto's numbers are out, and the total sales for the month of July are down 4% at about 3.5 lakhs compared to 3.69 lakhs. So the problem really is in the export market, and we've been highlighting this for a while. Export three-wheelers are banned in Egypt, and that's been the case for a while. Hence, there's been a big dip in exports. Exports are down 15% for Bajaj Auto on a year-on-year basis at 1.71 lakhs. The good part is the domestic business continues to improve. So 9% growth in the domestic business, but export three-wheelers are down 23% year-on-year for Bajaj Auto. So that is the big problem area. And now, of course, there's talk that perhaps Nigeria could also ban motorcycles. To that effect, there's no notification from the Nigerian government just yet, but that's another overhang. Harsha, good morning. Since we're talking about auto stocks, just wanted your thoughts here. It's so diverse, right? What's happening? On one hand, passenger vehicle sales are booming. On the other hand, there's still a slowdown in two-wheelers, and now export hit as well. How are you approaching it?
Sonia, we have built some positions in the auto sector in the last quarter or so, but we have been more positive on the passenger vehicles. That's where I think a lot of upside can be there in terms of stock movements. We have seen very, very strong interest for some of the product launches that have been there in the domestic four-wheeler segment. We also expect that the commodity cost pressure, which has been really hurting auto companies in the recent past, is not going to be that big an issue as we go forward. And hopefully, even the chip shortage, which played havoc, is unlikely to really remain an issue. So overall, we continue to remain positive on the auto segment, but on a relative basis, we are more positive on passenger vehicles as compared to.
Okay, all right. Hi, Harsha, always good speaking to you. Well, the other sector that came back with autos is the FMCG space. Out of nowhere, both those two were a bit of laggards. Both of them in the past 1.5 months or so, they have had the best run. How do you approach that space, FMCG stocks?
Nigel, on FMCG, our view is still more bottom-up in nature. We have some stock-specific positions there, but as an overall sector, we still are not in an overweight position as far as this sector is concerned. We believe that the valuations overall have not corrected to an extent where we can really take a very large top-down call on the sector. Nevertheless, we do have stock-specific positions in the portfolio, and that we are continuing to.
Markets, by the way, pulling back in the other direction now. We're up 50 points. There was a bit of a come off early on, and then things started picking up sharply. Harsha, I wanted your thoughts on a smaller area, the QSR space, right? What's the right way to pick the right name here? Because there is a fair bit of option now, right? There is Westlife. There is the Pizza Hut, the two companies. There is a KFC. There is all of them are listed now. Do you own any, and how should one go about picking one of these names? Because this also perhaps is an under-penetrated area, and the runway for growth is pretty long. Westlife reported great set of numbers last week. Go on.
Yes, Prashant. I think when you look at the overall runway for growth, there is a very, very large runway for growth as far as QSR business is concerned. But you need to be more stock specific and see how the distribution strength is going to be different across some of these names and how they are approaching in terms of penetrating more of tier 2, tier 3 cities. Because most of the growth going forward would come from those centers. And in case the companies have very good distribution in those parts of the country, and if they are cost conscious, I think those business models will definitely do well. And that's how we are approaching this business.
Okay, well, Westlife is the stock that's in focus, but a couple of these other consumption brands, consumption stocks also doing very well. Metro Brands is up almost 10% today. M&M, a big barometer of consumption. That one is also your big mover, up about 5% right now. Fresh 52-week high there. Page Industries is up almost about 1%. That's on the consumption piece. But Harsha, I wanted your thoughts on real estate. I mean, that's also a barometer of how income levels have gone up, affordability has gone up. Mr. K.K. Mistry was making that point a while back. And very good numbers from the likes of DLF. In this entire ecosystem, the real estate ecosystem, what is it that you still like?
Yeah, we do have a couple of positions in the real estate segment. As you rightly mentioned, there is increased affordability as far as real estate is concerned in the current times. So we have also seen a lot of inventory going out of the system, which is definitely a positive. And while interest rates have started to move up, I don't think when you are taking a 10-year or a 20-year home loan, that's going to make a huge difference. And definitely on a relative basis, affordability has gone up much more than what interest rate hikes would chip away. So to that extent, we continue to remain very positive on the real estate space. And not just the real estate space, in fact, all the ancillary businesses which support real estate. For example, almost all of the home building, home improvement segments, cement, these are the pockets where we've been positive on. So as an overall real estate play, we are not just playing real estate companies, but we are also playing some of these allied businesses, which are definitely going to see stronger demand because of the uptick in the real estate segment.
Okay, all right. Harsha, since we spoke about cement, I want to ask about the metal pack as well. That's obviously more global facing in nature. But some of these companies, their balance sheet is in far better shape. I think it's the best in the last decade or so. The problem is China is still very, very sticky. Do you think that these bounces that we're getting are just trading bounces as of now? And, we could see further pressure? Or do you believe that valuation-wise, they come to fairly attractive levels?
Yes, I think as far as the balance sheet is concerned or the valuations are concerned, clearly there has been a lot of comfort metal companies at this point of time. But again, as you rightly mentioned, these are the stocks which are largely driven by what happens in terms of global demand and supply and the pricing in the global market. So to that extent, it's going to remain volatile in our opinion, because the global growth is really slowing down, and most of the focus in the recent times has moved away from inflation worries to growth concerns. So as long as there are growth concerns, very unlikely that any of the commodities on a structural basis will continue to perform. We will have to be careful in terms of entering at a valuation which is comfortable and exiting whenever you feel that you made a reasonable amount of those stocks.
Right. Harsha, how are earnings expectations moving for FY23? So out of the Nifty 500 companies, I think about 210, 215 companies have reported numbers. And, quarter on quarter, numbers are absolutely flat. Actually, profits are lower. Year on year, of course, because the base was very low, there's a big jump. How are you reading earnings so far which have come through?
Prashant, as you mentioned, around 40% of the companies have already declared results. But as expected, there has been a significant pressure at the margin level. EBITDA margins across industries have seen shrinkages. That was anyways expected, but that has made overall numbers look a lot lesser than what the expectations were, I would say. As far as Nifty basket is concerned, it has just gone up by about 10 percentage points on a year-on-year basis, which is much lower than the expectations. Obviously, this is driven by some of the large companies which were actually expected to be large part of the incremental earnings growth have kind of disappointed. So overall headline earnings numbers have also contracted in that sense. So our expectation is the 18 to 19% expectations for financial year 23 in terms of earnings growth may not really come through. So there will be a cut in estimates as we go forward. But as long as it is only transient, and if the belief is the inflation worries will reduce and the demand will still continue to remain robust, then I think FY24 numbers will not be cut. So to that extent, the market may make a sideways movement for some time and then start looking at financial year 24 numbers. That's the best possible scenario. But if these inflation worries continue, or if growth slows down more than what the expectations are currently, then I think there will be a chance for markets to still go down further.
Okay, by the way, Cipla is one stock that's really charging away right now. A lot of brokerages, have an overweight or a buy call. They've raised their target price after the strong performance despite the COVID base. And the company maintaining its margin guidance for the full year at 21 to 22% is something that has, kind of enthused the street. Harsha, on pharma, there are a lot of companies like Cipla that have some big ticket US launches on track in this year. Do you think this is a good time to be in pharma?
Sonia, we have never been top-down buyers in pharma because some of these companies have their own underlying dynamics, which can be in contradiction to what happens to the overall sector at many points of time. So to that extent, we do not have a very big position in the sector, and also we have been more stock-specific and looking at positives to buy into some of these things. As far as valuation is concerned, I think just like many other sectors that we spoke about, even the valuations in the pharma sector have corrected to a great extent. So yes, we will look at this sector, but more on a stock-specific basis.
Final question, Harsha, before we let you go. The big debate, IT, is the best to come, is the best behind? Which camp are you in?
Clearly, macro is looking weaker than what it was a couple of quarters back. I think a couple of quarters back, if you look at the commentary from most IT companies, was about the strong pricing power that they had and how the business demand was improving. But clearly, there has been some weakening in the expectations of growth. And also, we have seen some of the discounts coming back into the market. So overall, I think here, compared to expectations, growth is going to be weaker, and also margins are going to be under pressure. And at the same time, the valuations as compared to, let's say, NASDAQ index or global tech sector has not corrected as much. Indian IT sector has not corrected as much as some of those sectors. So I would say that one needs to be still cautious on IT. There are relatively better opportunities elsewhere, and that's the way we are building up.